know the second invite. Set up, follow the instructions, set up your accounts, set up the tickers, be ready. Maybe you can set up all the tickers just to be on the safe side, then you can straight away trade. And the moment you want to trade on options, you just right click on it and just straight away, because I've been using the option trader, so it's already got that as one of the options. Otherwise, you just go to trading tools and click on option trader, and then you'll get to the option trader interface, which I have here. I still have the crude oil options because in our time when we are having our classes, the US equity options won't be live prices for those options because the underlying the options market and the underlying market are closed. Okay, so that's why I have kept okay. So let's start okay, so our next question is, the next point we wanted to study about options as we we traverse our introductory coverage of options. So we want to talk about aspects of an option contract. Does anybody know what I mean by aspects of an option contract? So aspects of an option contract essentially is just any, we try to, let's just open this. So the point of, what I mean by aspects of an option contract is that if you walk into a consumer electronics store and you tell the salesman, I want to buy a TV, is that enough information for him? He needs more information. What screen size, LED, LCD, whether you have a brand preference, how many whether you need a RGB port, how many USB ports, whether it's a smart TV, all kinds of stuff. You need to clarify a lot of other stuff before he can actually take you to the right TV. Eventually you come to a brand and model combination which has all the specifications, right? This is clear? So it's the same thing, that if you just go and tell a market maker that I want to buy an option, that's not enough information for him, right? So what information do you want to give him? We want to be clear about that. So if you're going to a market maker and asking for an option price, what information do you have to give him? Anybody wants to volunteer? Maturity. Okay, so we call that the expiration date. Okay. Expiration date. I'm just going to write short form here. Okay, expiration date is 1. We can write this. Okay, we can just write this as. Yeah, next thing you said is? Strike price. Okay, this is the point that Kanika raised yesterday. Strike price. So I'm just going to use shorthand. You don't need to remember all this stuff. Basically you should be able to work it out every time, and then eventually it will just become embedded in your memory. So one is obviously expiration date you need to mention. Then you need to mention strike price, and what is the third? Quantity. Quantity, yeah, okay, fine. We can write quantity also. Quantity, number of contracts. This quantity will be number of contracts. Number of option contracts. Yes. What do you mean? Can you use better language for that? Asset market, underlying market. Okay. So underlying market, and usually, and if you go back to what we learned here yesterday, that we learned some new things yesterday which you may not normally find in most textbooks. That we learned that all kinds of instruments can be underlying for options, including options. Okay, so this part is normally not mentioned in most of the textbooks. So if we look back, if we go and just open that thing once again. So therefore, when you're talking about underlying market in the context of options and in the context of this question about what are the aspects of an option contract that you have to specify in order for the market maker to understand exactly what you're looking for, right? So therefore, when you're talking about markets, you have to, maybe we need to make it a little smaller. we can see pretty much everything we need. Okay, options a little bit. So when you're talking about underlying markets, in the case of the option, you have to really talk in terms of it's not sufficient to talk about underlying as base, let's say dollar yen. If you say dollar yen underlying, that's not good enough, because you further have to specify the instrument. Okay, because you could be talking about dollar yen spot, or dollar yen forward, or dollar yen futures, okay, or dollar yen options. Maybe you're looking for a compound option on dollar yen. So therefore you have to, when you talk about the underlying in the context of aspects of an option contract, you need to talk about the underlying as a market instrument combination. Okay, so we write that here as, so underlying market, okay, really is has to be in the, you can write equal to here as market into instrument combo. So it is not sufficient to say I want an option on dollar yen. You have to say I want an option on this part is in your notes. Okay, this is in your note the file in which this. So these things you don't have to. But I will try to write less today, because I noticed that there were no views for the video yesterday. So people are again falling back on notes and not watching, because there's some stuff which is in the videos like credit derivatives, the discussion on credit derivatives, which is not in the notes. So it's actually what is required. So I'll write less and less. But some of the stuff, because when I'm asking you guys, I need to note down what she's saying, add up the points. So the point to understand, underlying market is not sufficient to say dollar yen. You have to say dollar yen futures, spot dollar yen options, all this stuff. Okay, so it has to be mentioned as a market instrument combination. And in the context of this particular project that you're doing, what is your underlying going to be? This US equity option trading project that you're going to be doing, what is your underlying going to be? Like one of the markets is Microsoft common stock, but it's, what is the instrument? Spot. Instrument is spot. Okay, so it's basically spot market for Microsoft common stock, Amazon, Ford, etc., etc. Okay, so therefore the market instrument combination concept has to be there. Okay, so when you're talking about the underlying market, because you can have options on all kinds of instruments. Okay. All right, anything else? Expiration date we've got strike price, quantity I didn't have as a point actually, but we can have that as well. It would be initially, I assumed it was just for one contract, but that's okay, that's a valid point. You can have quantity, strike price, expiration date, market into its market, underlying market. What else? Anything else? Yes? Spot price that you have already, don't say spot price, because then you're fixating on one type of instrument. You have to say underlying price. Okay, what you mean, you should refer to it as underlying price, don't say spot price. Okay, because the underlying may be a dollar yen option, a dollar yen futures contract. Okay, so in that case the spot price is not correct. Okay, so you have to really say underlying price, but the underlying price is not, you have already specified the underlying price the market maker will figure out on his own. Okay, anything else that we can see? What have you told him, LED or LCD? What is the basic? I only said to the market maker I want to buy an option. So what is the basic thing? Call or put you have to specify. Call or put, okay, that you have to specify. So you've specified call or put, you have specified the exercise price. I also don't have it memorized, so we have to just see if everything is okay. Call or put, you have to specify the expiration, the exercise price, expiration date, underlying market. Okay, so we have 1, 2, 3, 4. There's one more element which you may not be familiar. When you studied options in FM1, FM2, did you study about exercise style? Yes or no?
No, sir.
Okay, fine. So there's one more element which is called exercise style. Okay. Why do you think, if you see when I went
lost.
Why, when we were defining options earlier, why did I add this kind of a convoluted phrase? Because the person who was, I think Tarun or somebody was mentioning time, only mentioned a particular time, but I added this at or up to a specified time, and I think somebody mentioned as well that there should be up to. It could be up to a point of time or at a point of time. Okay, and then I added not just time, but I added times. Okay, so you have basically you have three types of exercise. Okay, and this part I will. So clearly the internet connection is erratic because this software is losing its connectivity many times. Okay, so we have specified call or put. Okay, underlying asset we have specified as a market instrument combination, expiration date, strike price. This is the part that we have not specified. Okay, so you have three types of exercise. Okay, American, European, and Bermudan. You can read this. Okay, so you've heard about, so you've been taught about American and European style exercise, but you've forgotten. Sorry? Yeah, don't say expiration, say expiration. Yeah. No, you're actually saying it the other way around. So what she's saying is she has mixed up the definitions of American and European. American is at any point of time. So these particular things that you're doing, this is just a matter of convention. Okay, so like foreign exchange options, spot options, foreign exchange are actually European style on spot. Okay, so in this case, by convention, the US equity options are American style. Okay, so American style means essentially even if you buy a 9-month option, you don't have to wait till the end of 9 months to exercise the option. If you want to exercise the option, you can do it anytime. That's because these are American style options by convention. Okay, this is just a matter of convention as to what what the market decides, what kind of option it wants to trade. So the point is that there is a fifth element which you have to specify, which is actually a sixth element, because Tanya added the matter of quantity, number of units you want to buy, which is correct actually. So we should add that here. We'll add it as a 0, that will be better, so I don't have to disturb the numbering style. Which is number of contracts, which is already there in that other note, so I'll add it here. You can write, sorry? Yeah, you can write quantity. I'm just writing quantity as number of contracts, because in option you'll be leading at, you can write position size or you can write amount, same thing, comes to the same thing. Because in this exchange, number of contracts arises when you're doing exchange traded options, but when you're doing OTC options, you will be talking about an amount. Okay, so you can write this as both. Basically, you can write it as amount, okay, and you can write it as number of contracts. Quantity is already written as quantity. Amount or number of contracts. Okay, so we have this thing to understand. There's another element to understand, that because an option is a contract, it confers certain rights, and so those rights are, one of those rights is basically talks about when you can exercise. So if it is American style, you can exercise at any point of time from the time you buy the option till the expiration date. If it is European, it is at any point, it is only at the end of the period. And if it is Bermudan, then it is at specified points of time. So you might have a Bermudan option for 1 year where you can exercise at the end of every month, but not within the month. So every last day of the month. So you could have like, if it's a 1 year option, you could have a situation, a Bermudan option where you can exercise on the last day of every month, but not anywhere in between. Okay, so that becomes a Bermudan, which is like a cross between the American and European. Okay, so you need to put in all this stuff. Obviously, this the other elements which you can see from this itself, which is so these are the elements that you have to specify. Okay, when you have exercise style, you have American style, European style, Bermudan, and then the market maker will put in the other stuff. Okay, like you were talking about the price of the underlying, that the market maker will figure out for himself. Okay, he will figure it out. He'll look at the market price. So some of the other inputs that go into it, which you can easily see when I've already given you the link for this, and I think I have pasted some other links. Not yet. Okay, I'll just paste them today. So a whole bunch of other links that you have. I'm just going to paste them here. You guys have the 10th edition of the book or the 9th edition? 9th. You have the 9th edition, bro. So one of the things you can do is you can read this on the global financial crisis. If you want to get a little bit more of a slightly more technical reading on the global financial, well, I will not have time to cover this. Okay, so you can read this for yourself. It's optional reading. I'm not putting it as part of the syllabus. It's optional reading, and you can read this in chapter 8 of the Hal Basu. Okay. Let me go. Sorry, not here. We are not trying to go here. We are trying to go. Okay. So. So there's a whole bunch of links which you can use, okay, all kind of stuff, all this optionprice.com which I'm using. Okay, so here you can see that there's some other inputs which the trader, the market maker himself will find out from the market and enter. Okay, one of these is the vol. Okay, this is referred to volatility. In the future we are not going to use this big word anymore. We are just going to call it vol. Okay, so this thing he will have to find out an input. Okay, and he will determine it himself. So the other is dividend yield, which I have described here as the three other things that he has to clarify. Okay, so one is the vol. You can see that he's taken the vol. You can look at this formula, and this you have the link to the software. You can look at it. One is the vol. Okay, no, this rounding is not really. This is for the software. Rounding, we don't count this as a factor in the option pricing. This is just a particular way of the software wants you to know, like it wants to tell you. Basically, the software is asking you to tell it up to how many decimal places do you want this. Okay, so this is not a factor which we consider when we are learning the theory. What we really want to know is what is the interest rate and what is the we don't want to just talk about dividend yield, because dividend is only paid by stocks. That's why I have talked about the expected yield on the underlying asset. Okay, so these two are actually quite similar. If you see interest rate is if you buy the asset, if you borrow money and buy the asset. Remember, we already mentioned that in finance we want to talk about everything. Whenever we discuss in finance, whenever we are buying something, we are buying it and putting it on deposit, okay, and earning a return on it. Or if we are selling it, we are borrowing it and selling it. Okay, so this idea needs to be there. So interest rate and expected yield on the asset essentially are you can think of the interest rate as also involved in when you are using borrowing to finance the purchase of an asset. You have to pay interest on it. So the interest rate and the yield on the asset are kind of two sides. Like you take a housing loan and you finance the, let's say you take 100% for the sake of argument, we assume you take 100% housing loan on a house. Okay, no bank will give it to you, but in the global financial crisis, in the run up to the crisis, some of the banks were doing that, zero money down. So you would get the 100% of the value of the house would be loaned to you. Okay, so but in normal times it doesn't happen. Okay, but let's just assume for the sake of argument, so you buy 100%, take 100% loan, buy a house, and then you put that house on rent. So the rent is the return on the asset, and the interest you're paying on your housing loan is the cost of the asset, right? So you can see both sides. So that's why you can see clearly, basically we have two other elements which we have to put in, which you can just look at the formula. So the interest rate on which basically deals with the financing cost of buying the asset, and the expected yield. So I've written this it should be thought of in a more general way, expected yield on the underlying asset, because this is actually this is for pricing stock options. Okay, that's why it talks about dividend yield. Okay, so that's why, because we don't want to use a word like dividend yield, because dividend is a very particular word, it applies only to stocks. Okay, so in the case of bonds it will not apply. So that's why I've used we should think of this as a more general term, which is the expected yield on the underlying asset. Dividend is an expected yield on the equity holding. Are you following that? Do you agree that dividend is an expected yield? So if I use a general expression like expected yield on the underlying asset, when you are talking about stocks, that becomes a dividend, right? So these are the three other elements that the market maker has to enter. And then obviously, as you were saying, underlying price, he needs to know what the underlying price is. Okay, suppose he finds, he will look at the market. These are talking about spot equities. Okay, so exercise price you have mentioned to him, days until expiration, etc. Okay, interest rate and all he has figured out, and he puts in all these numbers. Maybe he puts in something else for volatility. He can put in maybe 45. Okay, so we'll come to this determination of what this vol is. Okay, and how this number is derived. So at the moment, in our superficial assessment of superficial coverage of options at this point of time, we just know that there is also a vol input that needs to go into this option pricing model. Okay, so this is actually what we will discuss later on, the difference between price and valuation. This normally in the industry, this is referred to as an option pricing model. Okay, but actually it's really an option valuation model. All right, so it's actually an option valuation model, but this, unfortunately, the word is stuck. So if you go and start talking, you can always explain it to them why you call it a valuation model or a pricing model. Okay, but these are generally referred to as option pricing models. So we may also refer to them as that, but actually they are option valuation models. The model as designed is a valuation model. Do you understand the difference between value and price? Not very clear, right? Okay, because many of the things, what is happening is you're being taught a lot of techniques, and people don't have a very good sense of, they don't have very good context about what exactly is, yeah.
So is there a difference between pricing model and valuation model? We can use it interchangeably.
So in the case of, no, in theory there is a difference. Okay, in theory there is a difference. Actually, pricing model is not a good expression because you don't need a model to price it. The market prices things based on the interaction of supply and demand. Okay, so option pricing model, which is used everywhere, even in the academic finance literature, that actually is wrong. You don't need a model to price something. You need only a valuation model, because pricing is anyway done by the market. And later on, when we get into the I-vol concept, okay, so everywhere vol means volatility. So if we get into, once we understand what I-vol is, okay, and then we'll talk about two different types of vol: historical volatility, which we'll call H-vol, and implied volatility, which we'll call I-vol. Okay, so once you get into that, you'll understand that actually this is really, it's kind of like it is now being used as a kind of a cop-out, because really they're taking the market price and putting it into the this valuation model. Okay, so but it's important to theoretically understand what is value and price. Like you are doing this corporate finance modeling course which has started now. For instance, I saw your senior Sinha, was your senior Vaibhav Sinha? So he did good work, but he was not clear. He came out with an analysis. He did a lot of good analysis and all that, calculations, but then he came out with a valuation of a stock actually, okay, which I think he came out with a price of 74, and the market price of that stock was 414 or something. And in his presentation, he never talked about that difference. So I found out what the market price was, and it was 414. And he came out with a valuation. So you have to be clear what most of these models are actually, that's actually what you're doing there. These are actually valuation models. These are fair value models. Okay. So you have to understand these kinds of things. So many, you need to have that context. Hopefully we'll have time to have that discussion. Okay. That what is, so you have to, that analysis is not complete. So he just did his projections, he did his assumptions, he did his projections. He did a lot of good Excel calculations. Okay. So he put in some solid work. It was not a, bad job, but the point is that he just came out with 74. Okay, my job is done, but the market price is 404. You need to say something about why, because the market price is more important than your assessment of 74. So if the market price is 414 and you are coming out with 74, your analysis is not complete until you make some comment about the difference between the market price and your assessment. This is called fair value. Okay, so you have to understand basically that since we are having this discussion and we are talking briefly about models, maybe we should understand, maybe we should have this brief discussion. I think because you guys are doing other stuff also, so let's have this brief discussion now and put it down in your notes. Okay, these are the links. This is just this is one point, and we are talking about aspects of an option contract. Are you guys following the discussion so far?
Yes, sir.
Okay. And now we are talking about, let's have this important, very, very important discussion, okay? This is basically called, this is the discussion on value versus price, okay? So we are making basically, but this is a very fundamental element which you will not find in most of the books. So it's important that you be given this definition. So let's talk about, to understand this, let's also go to your calc, which is in your, let's go to your calc file. Now this is already with you, okay? So this you have access to, you don't have to worry about this. Now remember when we were talking about decision problems, right? We went through many of the decision problems. We talked about, we said that asset class, market and instrument, these are decision problems, but these are normally solved by the investor. You can see how in this particular project, once again, I'm tying your hands. I'm not allowing you to trade crude oil futures and stuff like that. I'm forcing you to trade. I'm boxing you into this. Just like in the first project in IPM, I boxed you into this same box. I'm actually boxing you into the same box. Right? In the first project, I boxed you into this box, and as a subset of this box, I boxed you into the Indian sub box. Okay? Now again, now what I'm doing in this particular project is something different. Okay? Once again, I'm tying your hands. Your instrument hand is also tied. We said asset class, market and instrument. Our asset class, market and instrument are the first three decision problems. Which asset class should I invest in, which markets, which instruments, okay? And so in the first project, I tied your hands by putting you into this box, okay, spot equities, and then further I tied your hands by putting you into the Indian sub box. Okay, you could not trade Toyota Motor stock on the Osaka Stock Exchange. You didn't have the freedom to do that. In this project, I am further tying your hands. Where am I going? I'm going into this intersection. I'm going into equities and options. FB options is just given as an example. Okay, and further inside this box, I'm tying you into the US sub box. Okay, so you have to imagine it this way. So once again, asset class, market and instrument, these decisions are normally made by the investor who's financing you. They will typically put some constraints on you, or sometimes the money manager might himself say, I only want to trade commodity futures, and my fund is focused on commodity futures, and then he'll go and target investors who might be interested in such a narrowly defined fund. Okay, so either way, it gets defined very quickly and mainly based on expertise of the investor and the liquidity considerations and things like that. So that solves these three important decision problems. Now we went into the other decision problems. Okay, but you notice one thing we did not cover initially. I just told you for buy and sell, you just look at charts and form your view. Like I've formed a view that I've gone long Swiss franc, dollar Swiss. Okay, so I've gone long dollars because my view is that this uptrend from here is not yet over. This is going to go up. So just look at the chart. And this is a legitimate approach. So this is the technical analysis approach. You just look at the chart, think of it as your surfer surfing waves, and just take a view on where the next wave is going. Okay, this is a completely legitimate approach, but this is the technical approach. So here we were trying to solve the buy-sell problem, so we didn't spend that much time on buy-sell. I just told you that for buy-sell, you do it this way, right? For buy-sell, you do it this way, right here. Okay, so you just look at, so we looked at only the TA. So here it says solved either by using TA or FA or AFV. Okay, we'll come to what AFV is. Okay, but we had a limited discussion on the buy-sell decision problem. We only gave you the technical way to solve it because, and the reason we did that is because we didn't have time. So I could give you a very simple technical approach, okay, which is a 100% legitimate approach, but I could not give you a comprehensive discussion of buy-sell because that would have taken more time, okay, and we needed to get you going on the project. Okay, so now we are going to come, when you come to this, so is this clear now? What is the context? Okay, so we did not adequately address the buy-sell problem. So we'll now go into that, okay, as a fundamental prelude, because since you're doing this other course also, you should understand. Where is your calc? Yeah, okay. So in your calc file, you'll find that there is a sheet like this, okay. This is called DP4 paradigms. Why DP4? Because decision problem 4 is to buy or to sell. Okay. Now here you need to have this comprehensive perspective of how, I don't know if you can read at the back. Kanika, can you read? You're able to read all the stuff, value agnostic and all this stuff. Okay. All right. So essentially, it's still not big enough to capture everything. I need to maybe make it even smaller, but I'm not going to make it smaller because then I don't think you can read then. Okay. So here you try to understand this, that there are two broad ways to solve this buy-sell problem. Okay, you need to understand the theoretical framework. This is total theoretical framework. Okay, and you won't find this anywhere, so you understand this because this is how basically it is. Okay, so there are two basic approaches to solving the buy-sell decision problem. Everybody understands the buy-sell decision problem? Any asset you're looking at, okay, any market instrument combination that you're looking at, you have the fundamental problem: should I buy this or sell it? There are two basic approaches to solve this. Either you have a value agnostic. You know what an agnostic is? Agnostic is basically, you can think of agnostic, this is not very well defined, but agnostic is somebody who's not really sure, who doesn't really know, okay, or doesn't really care. Okay, so you can say agnostic is someone who doesn't really know whether there's as opposed to a religious person, okay, who knows that there is a Jesus or a Allah or Vishnu or whatever. Okay, he doesn't really know whether there is any God. He doesn't not particularly bothered about this question. Okay, so an atheist, these are again not very well defined, but I'm defining it for the purposes of the discussion. A better way to define an atheist is someone who is convinced that there is no God. Okay, so you want to distinguish between an atheist and an agnostic. An atheist is opposite of a religious person. An atheist is convinced that there is no God. Okay, and an agnostic can be defined as someone who is not really sure. I mean, I'm not sure if there's a God, but I'm also not sure that there is like this Jesus Christ and Muhammad and all these people. So I'm not sure. I really don't care. I'm not particularly bothered. Okay, that's an agnostic. Okay, so what I mean by value agnostic means basically I don't care about value. You'll understand what value is. Okay, so one is value agnostic, which is purely price based. This you're already familiar with from what I told you, what I've shown you here, what I'm doing here. I look at this because of course I have a longer term perspective also. My view is this overall uptrend in dollar Swiss is going to resume. There's actually a daily uptrend also there. So that's why I've gone long, because my view is this from here, the long-term uptrend has started again. It's going up. This is not complete. It's going to eventually break above this, go above parity. This is called parity. In all these exchange rates, when we talk about, oh, is the euro going to parity? You might hear such a discussion in the markets if you're listening to TV, which you guys are not doing enough, I think, business TV. You'll hear a discussion like the euro going to parity. Is cable going to parity? Parity just means one. So in dollar Swiss I would say dollar Swiss is going to go through, break through parity and go higher. Okay, that's my view. So this is just basically, I don't really care about value. You'll see what value is later on. I'm just looking at price. I'm only concerned with price. So at this point, we want to make the distinction between price and value. Okay, so this is so, but broadly understand the basic difference is. Okay, so the broad difference we are making, you understand this framework? That the pink part is the high level classification. Then under the pink part I have these further breaks. You're able to follow I'm not saying you have to understand what, visually you're able to follow this, right? Visually you're able to follow what I'm showing, the boxes, okay? So the broad split is in the pink part. One is value versus price comparison based analysis, one basic approach. So there are two basic approaches, okay? So you have, and the other one which you're familiar with, which is the TA approach, technical analysis, okay, which we are only going to refer to as TA, okay? This is what it says here. This is TA, in case you're not able to see it. So on this right hand side we have TA, okay? Technical analysis. Okay, I've not sort of written technical analysis, but TA is technical analysis. So in technical analysis, what you have seen already, we've discussed many times. I look at this chart, I form a view that this thing is going up. Okay, I don't really care about value. I'm only concerned with price. Okay, so let's understand what is the difference between price and value. And this we should write down here. Value versus price. Now, which is objective? Price is objective and value is subjective, or value is objective and price is subjective? Value is subjective. Okay, good. So value is subjective. Very good. So this is the first thing. Were you aware of this distinction before? You were aware? Some of you are aware, but not everybody. You have not discussed it directly anywhere. Okay, so it's important. This is a very fundamental distinction that you should be aware of. What do I mean by price is objective? What is the dollar Swiss price right now? 99.20. Okay, we just say 99, we don't say 0.99. So 99.20 is the dollar Swiss price. Whether you like it or not, this is the price. And there is no doubt about it. Somebody sitting in Tokyo can see the price. Somebody sitting in Nigeria can see the price. It's the same thing for everybody. This is the price of dollar Swiss. Okay. Similarly, what was the closing price of Microsoft in New York yesterday? 136.33. There's no dispute about this. You may think it's too high, too low, doesn't matter, but this is the price. It's objective. So price is always objective. That's why I said that when the finance literature uses, and industry people also use option pricing model, that's actually not correct, because pricing you don't need to have. Basically, you can see here the prices of the options. If you see, this is for the underlying contract here, which is, this can't be the October 19 contract because it's going beyond the October 19 expiry. So for this, actually, is the next contract which is there here. You'll see. Okay, there's actually, I'm not able to pull it down right now, but this is actually this will have to be a later contract. Okay, so this is a 120-day. Let's look at this one. Let's say. Okay, so December also, this will have to be the December or January contract. Okay, where you can see these are the prices. So these are the prices of options. Okay, if you're looking at call options, these are the prices. These are essentially determined by demand and supply. Okay, in the marketplace. Okay, so now therefore basically you don't need a pricing model term is actually not correct. Okay, because pricing is done in the market and pricing is objective. Okay, price is whatever it is. Okay, so okay, so price is objective. Now what is value? Now if you see why value is subjective, if we go back to these under this, so there are broad approaches. Value is subjective in the sense you might look at some particular asset, you might look at some price, you might see when you have these discussions, right? Some people say that, let's say you look at Tesla stock, okay, some people might say that Tesla is undervalued at this price. Okay, if you listen to the discussion, there's a very wide divergence of views on Tesla. You will see one camp is actually saying that Tesla is undervalued. Okay, this company has huge potential. So the fair value of Tesla is maybe something like $600 or something like that. Okay, so that you've heard these kind of comments, undervalued, overvalued. Yes. You've heard these comments. This is what they're talking about. Okay, so when they're saying undervalued and overvalued, they're essentially disagreeing with the market price. They're essentially saying the market price is not correct. Either it's overvalued or undervalued. Again, that terminology is not correct actually, but this is what they mean. You've heard this expression, undervalued, overvalued. So this is basically, where is this value coming from? Let's take the example of Tesla, where there's actually a very wide divergence of views. I've never seen a stock where there's such a wide some people think this thing is worth zero, that this is a fraud. And some people think this is worth, like I've seen one lady coming on and talking about, I think she said something like $2,500 or something like that. The fair price, which is now trading at $242, she said it's just $2,500. Okay, so where is all this stuff coming from? Okay, now first of all, understand that these people are talking about, when we talk about value, what we are talking about is, you need to understand this. This is fair value. Okay, this is an important concept in finance. When we're talking about value, we are talking about actually fair value. Okay, so when this lady comes out and says that Tesla is worth $2,500, that is her assessment of the fair value of Tesla stock. Okay, now where did so understand this. Okay, so the price is always clear, no doubt about the price, 242.7, but she thinks the fair value is $2,500. Okay, so now that's basically the value or the fair value. So to understand that, now where is this coming from? Okay, you remember now, so now we look at, so now we have some idea about the broad difference at the high level, which is technicals versus not just fundamentals. There are other approaches. Okay, but the basic difference is in technicals. Do you understand that we don't care about value because we only look at price. We don't care about anything else. Okay, we don't care whether it's undervalued, overvalued, all that. All I care about is which way is the wave going next. Okay, like here for instance, I would form a view that actually, although long term I'm not sure where it's going, but this one wave is over, I think. So I think actually that Tesla will actually rally now. moving up to about 320 or something like that. That's my view. How do I form that view? I just look at the price. Based on the price pattern, I take a call on where the wave is going next. I'm not interested in where their battery plant is located, how many cars they're selling in China, whether they got a tax concession in China. I'm not interested in all these things. Okay, I just look at the chart and I think this is where the chart is going. Okay, that's basically what you mean by TA, which is value agnostic. Understand that this is value agnostic because I'm not really interested in what the fair value is. All I care about is the price movement. Is this clear? This philosophy is clear? Yeah.
So like when you said you do not care about the news or about which is share.
Yeah.
But whenever we are buying shares about the Indian stock, in our previous project, we always look at news related to stock. For example, we were buying HDFC stock, we saw that they have declared a quarterly profit.
Yeah.
We said we expect that it will go up. That is our view.
Yeah.
So for while forming the view, we do look at the news. Is that wrong?
No, it's not wrong. It's just a different approach. That's all. So what I'm trying to show you here in this broad split, you should be aware of this, okay? Because this is again, remember what I said about mean reversion and momentum. You need to understand what kind of trader you are for yourself. By looking at charts, forming views, you will find that you usually fall into one camp or the other, okay? So typically you should understand yourself. That's very important. Understanding yourself is very important. What is your style as an investor? Okay, so that's very important. That's one of the important learnings that you should have when going through these elective courses. Okay, that you should, when you come out at the end of 2 years, you should be fairly clear about what kind of, you're a momentum trader, fine. You don't believe in fundamental analysis, you're a purely technical trader, also fine. You don't have to be that way, you can be the other way also, but you should be clear about what you are. Okay, so yeah, so it's not wrong. The answer to your question is it's not wrong, and I deliberately told you to do that because I don't want to box you into one style. I want you to also develop the feel for, from a fundamental perspective, because when I'm training you, I can't train you to be in one corner only. Okay, so you should be able, I have to train you in a comprehensive way so that you are then eventually it's your duty to figure out how eventually when you get into the industry, how you want to function. That's your duty, but I have to train you in a comprehensive way. So that's why I also told you try to follow the news flow and try to understand how try to see a connection between the stock price movement and the news flow and make your own sense of it. Right? I told you to make your own sense of it. This own feel is very important. Yeah.
So in value, we're creating our own perspective about looking at the other factors. So that will only impact the price. So how is it different?
No. I'll just explain. Let me explain a little bit more about value. Okay. So we took this. Are you satisfied, Chug? Okay. Your answer is coming a little bit more. Okay. Just wait for a while. Okay. So I have told you to do it that way because I wanted you to have the comprehensive approach. So that's not wrong. That just means that you're practicing. Even if you're practicing TA, you're also practicing FA. That is, you are looking at the fundamentals also. What Chug was doing, what he's talking about, looking at the news. That just means that it's not wrong. Okay. So, but understand this difference. Now let's take this example to understand this difference. Now what this lady is saying, fair value is $2,500. Price is over here. Where is she getting that from? You remember you've done all your dividend discount model and all this stuff that you have done, all the stock fair value earnings. Either you discount earnings with cost of equity or you discount operating cash flow, which you will probably again do in your CFM. Okay. So now where are those cash flows coming from? You're basically projecting in various years. Okay. You're taking like this year 1, year 2, year 3, whatever, year 4, 5, so on and so forth. Let's just take only 3 years. So you are projecting some cash flow at the end of the first year, some cash flow at the end of the second year, some cash flow at the end of the third year. This is how you derive all your valuations. Even your dividend discount model, you are projecting some dividends in future years. It's all the same structure, right? Whether you're putting in cash flows or you're putting in operating cash flows and discounting by the cost of capital, overall cost WACC, or you're putting in the earnings and you're discounting by cost of equity. Remember that, right? When your numerator is earnings, you have to discount by cost of equity. When your numerator is operating cash flow, you have to discount by blank. That means this all actually you have to discount by WACC. because the operating cash flow, the interest has not been paid, right? You have to add back the interest and all that, right? So that amount belongs to both suppliers of capital, debt suppliers and equity suppliers. That return that you're discounting, the operating cash flow that you're discounting, the reason you have to use WACC and not cost of equity is because that return stream belongs to both. Are you following?
Yes, sir.
That belongs to both suppliers of capital, debt suppliers and equity suppliers. But when you're discounting earnings, you don't discount by WACC because earnings is already at the last row. Earnings is already the last row. You understand? Earnings is net income, net profit, profit after tax, whatever you want to call it. Net profit, profit after tax, okay, net income, the US they call it net income. Are you following? You've heard these terms. Everybody's looking like I'm talking in Japanese or something. Profit after tax, have you heard this expression? Okay. So this is actually also something that I test for, but I just glossed over it because we are covering something a little bigger. But this point also should be clear when you're doing this CFM course, that what are you discounting? First you have to be clear about what are you discounting. What cash flow, I like to use the general term returns. If you use a general term like returns, it covers everything. Operating cash flow, dividends, earnings, whatever else, okay? Everything is covered in returns. Returns is a general term. So I like to use the word returns so that we don't use, always use general terms unless there's a reason for using only the specific term. So depending on what kind of return stream you're discounting, you have to see who does this stream belong to. I mean, who has to be paid with this stream. So when you're looking at the operating cash flow, you have to use that to pay both bondholders and stockholders. So that's why you divide by the weighted average cost of capital, okay? This is clear? And then when you're discounting, so remember this part, okay? So this is just, I didn't have an interactive discussion on this because obviously that takes more time. But I am just, shoving it into your brain that when you're discounting the operating cash, you have to use WACC, and you're discounting earnings, you have to use cost of equity because the earnings belongs to only cost of equity providers, right? Earnings is the same as net income, profit after tax. Okay. So this is what you do, right? So what is this lady doing? This lady who feels that this $2,500 is the fair value. Where is that thing coming from? Okay, this is basically like you go back to the example I gave you about your senior Sinha who came up with this value of 74 rupees. Okay, what is he doing? Essentially, he is using he's discounting operating cash flow projections, which is typically, I think, what you will do in CFM, because you will have to make lots of assumptions about capex and working capital requirements, this, that. So you will probably be focusing mainly on operating cash flow, okay, and then you will have to discount that, and then you'll get the firm value, and then you'll subtract the market value of the debt, and you basically go through a enterprise value calculation. So what is she doing? She is here. She is here essentially, okay? This lady is here. So this stock, you can use either dividend, you can basically do either dividend discount model or earnings discount, okay? Or operating cash flow, then subtract the enterprise value method, okay? But this is basically what she's doing, okay? So she's coming out with a value of this, which means what? So basically the main thing that is driving her fair value estimate, remember, these are all fair value models, okay? Have I used the word fair value somewhere?
Yes.
I've put it in your notes, okay? So when we say value, we will just use value because it's shorter, but what we mean is fair value. Fair value, why is it fair? Because when she's using this model, obviously she has to do some exercise like this. She has to put the years, and then she has to put the earnings figures. Let's say she's just discounting earnings to keep it simple. So then she has to put some earnings figures, okay? Now based on her estimate of the earnings figure, which can differ from Rajan's estimate, which can differ from Kanika's estimate, all can be different. There's no reason to expect that they all three come up with the same estimate. So this is why we say value is subjective. So what she is doing is based on her estimate of the earnings, because she basically feels that the adoption rate of electric vehicles is going to be very, very high. That's her main driver of her value estimate, and therefore she feels that they are going to sell a lot more cars and therefore they'll have a lot more earnings, okay? And that's how so how is she coming up? Basically, she's putting the numbers into this model, right? Same model that you got already familiar with, the dividend discount model or earnings discount model, right? Same model. She's putting in there, and then she's getting this fair value of 2005. Obviously, if you put in a big enough number in the numerator, you can always get a discounted value which is big. All I have, if I want a big discounted value, which is the NPV kind of a figure, right? Okay, or just the fair value of the asset, the discounted net present value of the figure of the future earning streams. All I need to do is put in a sufficiently big number in the numerator, and I'll get my return. Are you sure? Are you following? Right? I'll get a thing. So that is what is happening here. So that's why we say, and this is subjective, obviously. This value is subjective. Because actually there is no reason to believe that either she is right or Rajan is right or Kanika is right. Because they could all be wrong. Because we don't know what's going to happen in the future. Okay? So the basic uncertainty that just like in life, nobody says that, I'm going to live till 95. I'm very sure I'm going to live till 95. Nobody makes stupid statements like this, because we all know that life is uncertain. So that what you have to really understand, which you will never find in any textbook or any of these courses and all which are peddled, is that the basic uncertainty of life applies to markets and economies also. Eventually you don't know. Like you can see for yourself markets, how unpredictable markets are. Okay. So this you need to have this in your head, that this is basically just subjective. Okay, this is subjective because it depends on the individual's preferences. You can call it preferences. Okay, so this lady is very bullish. She thinks that the adoption rate is going to be very high. Okay, and there are some other people like Jim Chanos, who's a very well-known short seller. Jim Chanos thinks this company is a fraud. He thinks this company is going to zero. So he's actually selling Tesla short. Okay, so therefore because he feels that this is not going to be such a high, there's not going to be such a high adoption rate, and he feels there are lots of operating problems in this company. Okay, and one of the things he looks at is the high executive turnover. That he uses as one of the indications of a company in trouble. That lots of executives are leaving. Head of production leaves, head of legal leaves, head of marketing leaves, regular turnover, lots of churn. He sees that as an indication of a company in trouble. Okay, so anyway, the point is that this is subject. Who knows who's right? Okay, nobody knows who's right. So this is what the first thing you have to understand is the difference between price and value is subjective. Now you understand what value is subjective? You understand why value is subjective? So all these things, and even the stuff that you're going to be doing, you're basically be doing this. In your corporate finance modeling, you're going to be in this box, essentially. Okay? So this box is what I would call, it's a species of FA, what you guys are doing. All this falls under FA. Okay, this stuff that you do, this is most of the equity analysis that goes on in the industry. When you hear of equity analysts, okay, specializing in particular sectors, this is basically what they're doing. They're talking about, if you have a tech specialist, they'll be talking about, if you're listening to Bloomberg Technology, it's a very important program. I think everybody should listen to it every day. You really need to know what's going on. You'll see all these, there are equity analysts focusing on technology. So they'll come and talk about, okay, if they're talking about Apple, they'll say, okay, Apple's services revenue is going to keep growing. These are all subjective assessment. How do you know what's going to happen? But they will make some assumptions about how fast Apple's services revenue is going to grow. And from that, they are going to make projections about Apple's earnings. Okay, and then from there, they'll come out with a fair value for Apple. Like some people are saying Apple is still undervalued. Okay, so they'll come up with a fair value. But essentially, this is what you're doing. This is all what we call FA. Fundamental analysis. You have to look at the industry, you have to look at global growth, you have to look at US-China trade wars, you have to look at what is happening, any other competitors. Like one of the things they're saying is, now because Apple Watch, they have discounted the entry level price, $199. Now they're saying that's bad news for Fitbit, because that's going to affect the Fitbit sales. Okay, so these kinds of considerations, the point to understand is this kind of thinking. Okay, this is all what we call FA. Looking at how one product pricing, this market share, global growth, sectoral growth, okay, technological innovations, all this stuff, battery adoption, Tesla's battery factory efficiency, okay, what will be the rate of adoption of electric vehicles. These are all in the realm of FA. Okay, so basically this is what we call, this is what I mean by when I say, if you go back to the earlier statement about TA, this is what I meant, that in TA you are value agnostic. So when I took a view on Tesla, when I'm saying that this is going to go back to this level, basically roughly around here, okay, so just slightly above 300, I'm not talking about all this analysis and all. I'm just looking at the chart and making a projection, okay, which is also a completely legitimate approach, although many people in the industry try to pretend that this is not, but actually I'm telling you it's a legitimate approach, okay. So there you understand what is meant by value agnostic now. Now that you understood what is price is objective, value is subjective. And I've given you a flavor of what I mean by value is subjective. Now, does everybody understand why I say value is subjective?
Yes, sir.
Because how is value derived? All these models that you guys are going to be using again in CFM, these are all subjective. Be very clear about that. Okay, these are all subjective because you are making some assumptions about the future growth of sales and this costs and for future growth of capex. Okay, working capital requirement. These are all assumptions. These are just bunch of, I like to call models like a bunch of assumptions. Okay, nothing wrong with that, but you have to understand that these are a bunch of assumptions. Are you following what I'm saying? Very important to understand because sometimes people don't get it into their head. You know, they just churn out the numbers and they say, look, look, daddy, I've got this answer. You know, it's like the kid has done some major job for the first time. So you have to understanding that these are just a bunch of assumptions. Okay, so what Sinha should have done, what I told him to do at that point is, you came out with a fair value of 74 for the stock, but the market price is some like 414 or something like that. So now to complete your analysis, you need to then make some comments about the market price. Why is the market price so high? Obviously, their estimates of the market's estimate, if the market price is correct, okay, if the market price is correct, or if the market is using the same valuation models, if you assume, okay, then obviously the market's projections for earnings and revenues is much more optimistic than yours. So you need to make this connection. Okay, so and obviously nobody knows who's right. It may be that you're right and the market is wrong, and maybe the price will come crashing down. Okay, you don't know actually. But the point is, you need to understand why the market price is different. So you need to point I'm trying to make is that you need to make a connection between your fair value estimate and the market price. It doesn't stop at the level where you just came out with your bunch of assumptions. Like most of the students were doing it this way, that I made a forecast. So who cares about your forecast? You made a forecast. What is the value of your forecast? Okay, like is that at the end of they made a forecast and their job is over. Okay, I made a forecast. Okay, so you have to understand that these are all subjective, and then you have to connect it to the market price. Is this clear? Okay, so I spent too much time on this, but let's try and understand this framework. All this stuff you have done, now you understand what is meant by value agnostic. In TA, we don't care about all this value. We don't do all this market analysis. I just look at the price and I make a projection, just like a surfer. Okay, surfer is just riding the waves. He doesn't understand anything about the physics, okay, of why these waves are forming and all that. Okay, so the other thing that you understand is value versus, in this other box where you're doing FA, think about one more thing which you're doing. Okay, let's look at value investing. Let's look at value investing. What are you doing now? You understand. So let's stick with this example of the lady who thinks that Tesla's fair value is $2,500. Okay, $2,500. What is she doing? She's got a bunch of projections. She's made a bunch of projections. Okay, and she assesses that, because it is actually true that if you knew for sure that Tesla is going to produce these earnings figures in the next 10 years and next 20 years, if you had perfect foresight and you could see for sure that these are going to be the returns, then it is clear that the discounted value of those returns would be the correct value of the stock. Is that clear? If you could be sure, but obviously you're not sure. Okay, so instead of, you are just putting in a bunch of assumptions about what it would be, and based on this you're saying this. So according to you, this is why do I say, I'm now trying to explain why am I saying value versus price, comparison based analysis. How does the system work? Okay, how does this whole system work? Okay, the way it works is, So this lady does this analysis for Tesla, projecting the earnings, and she comes up with a fair value of $2,500. Okay. So what she will do now is she will look at her fair value. She thinks, she's pretty sure that these are the correct earnings numbers, and based on that the fair value should be 2,500. So she then looks at the market price, which is much below, far below the fair value. Okay, her estimate of fair value. Okay, and then let's understand this one more statement that people make. Okay, so she will say that this is undervalued. Are you following? No, let me put this down here. Undervalued. You heard this expression? Yes. Okay, in such situation like this, she will use this expression. She will say that Tesla is undervalued. Okay, this is what the market lingo is. This is what people do in the market. This is how they talk. Actually, this terminology is not correct. What she should be saying is, what she means is that is underpriced relative to my estimate of fair value. FV is fine if I write FP for fair value. Is that fine? So understand this. So you have to understand, you need to know what the market lingo is. At the same time, you also need to be aware of when the market is using logically incorrect language. Like option pricing model is actually incorrect. It should be option valuation model. But everybody uses option pricing model. You have no choice. Okay. But you should be aware that it's wrong. Okay. So when you say undervalued, what you actually mean is that because the market does not value anything, the market prices it. Okay, so you have to be careful about the use of price versus value. So when she says that Tesla is undervalued at $243 because my estimate of fair value is $2,500, what she actually means is that Tesla is underpriced relative to my estimate of fair value. Are you following? You should be able to understand what the logically correct statement should be. When people say it's undervalued, because the market does not value things, the market prices things. Okay, so value is something that exists in your head. Okay, C will one person will have one value, the other person will have a different value. These are all subjective estimates. Value is always subjective. Okay, other than certain cases of arbitrage-free valuation, which we'll come to, in which case it's essentially objective if you can execute the arbitrage. Okay, so basically what she means here is the market is underpriced relative to my estimate of fair value. Is this point clear now? Why I'm saying this? So this terminology is not correct, and obviously you have to flip it around for overvalued. When you say that something is overvalued, what you actually mean is it is overpriced relative to my estimate of fair value. That's very important. Don't say relative to fair value is nothing objective. Okay, like what time will the sun rise tomorrow? That's objective, we know. Okay, but fair value is my estimate of fair value. That puts in the emphasis on the fact that fair value is always subjective. It's my estimate of fair value. Okay, all right. So all this stuff that you have done, okay, in the case of government bonds, and obviously there's no uncertainty about the payment, especially local currency government bonds, although the Russian default is one exception to this. But generally you have to understand, when you're doing this kind of the FA, what we call FA, all your stock, dividend, Gordon growth model all falls under FA. Okay, and now why am I calling it value versus price comparison? So now when this lady sees this, her fair value is 2,500, but the market is trading at 240, 243. What do you think she's going to do? Buy or sell? Buy. She will buy. Okay, so this is what you call value investing. We had an earlier discussion about value investing and Warren Buffett and his style of value investing, and Howard Marks is also actually a value investor. Okay, although we normally think of, these are actually people which I should mention here. Okay, these are, I don't know if I've already mentioned this. I think have I mentioned this before? Buffett, Reed. I've mentioned Howard Marks memos. Yes, sir. Yeah. So let me just mention some other people that you should listen to. Very important figure. These are on the topic of people you should listen to. Jim Chanos is a short seller. You get a lot of interesting analysis. Okay, so this is actually off topic. These are just some names that you should listen to, that you should actually follow. I'm just putting it in italics, okay? Maybe we should just move this to another part of the discussion. Yeah, okay. All right, so underpriced, this is we have understood. Now what is she going to do? She's going to buy, okay? So this is essentially what value investing is about. It's about, first step, you have to calculate the fair value of some asset, and you should really think of value investing as being applicable to, although typically the market talks about it only in the context of equities, okay, and it gives Warren Buffett is one example of that. There are many other well-known value investors, but actually you should think of it as a more general approach which can be applied to any asset. And Howard Marks is an example, Oaktree Investments, which basically applies value investing to bonds. They mainly invest in bonds, but the same thing, the same analysis. The steps are basically this, that first you do your analysis of the fair value based on your projections like this. You project into the future, you predict the returns from the asset in the future, what you think will be the returns, you discount it using the appropriate discount rate, okay? Now here you have to understand this, typically when you have problems with your fair value, that is you come up with a fair value of 2,500, but you find the market never moves really from $240. It kind of pretty much stays there or goes lower. When you have problems with your fair value, there are two elements to this. One is the numerator and the denominator when you have the discount rate, right? In the denominator you have the discount rate. Usually the problem is with the numerator. Most of the time the problems arise because the return projections don't work out. Because in the denominator there's not much, it's not really very, the value is not really very sensitive to the denominator compared to the variation you can have in the numerator. So most of the time the reason these fair value estimates go wrong is because you did not get the return projections right. Are you following? This is where the errors in most of the models are. I mean, when you realize later on that you have problems, okay, so this lady thinks that, okay, it's going to 2,500, let me buy it. But eventually she finds that this keeps on dropping and goes lower and lower, which eventually what this typically means is that 2,500, there were two major drivers of that value. One was the discount rate and one was the return projections. So another thing that I'm telling you is that essentially the main problem is lies with the return projections. Usually the discount rate is not much of a problem in terms of errors, but the return projections are very prone to error. Okay, so this is basically, yeah, any question? Okay, so now what do I mean? So that's why I'm saying that I'm making this fundamental distinction between these two approaches to solving the buy-sell problem. One is, you notice, TA doesn't care about value at all, value agnostic. And in the second approach, I'm calling it value versus price. Okay, you notice what is common to all these approaches which you have already used: project analysis, stock analysis, bond analysis. You have done all these things. Bond valuation formula you have done, NPV, project, IRR, all this stuff you have done. In all of these things, what is common is you will draw up some future periods, you will make some projections about what returns will come out in those future periods, and you will discount those returns. It is common method of analysis, okay, for everything. That is the basic formula for the fair value of any asset. Project the returns, discount the returns, okay, and typically when you make mistakes, it means you got the return projections wrong. Okay, usually that's what happens. So this is a basic thing. And what are you doing here? You're comparing. And what is this lady doing? You see, in the first step she computes the fair value of 2,500, right, making her projections, right? The next step she compares it to the price. Can you see that? So the decision to buy or sell, can you see how the decision to buy or sell is driven by a comparison between the fair value and the price, right? If the price was also 2,500 and she thinks the fair value is 2,500, then she would not have bought, right? Because it is correctly priced. Are you following the logic? Why am I saying that? Because why are we discussing these approaches? We are talking about what are the broad approaches to solving the buy-sell problem. One is TA, value agnostic. Now we're talking about the other type, which is the other approach, which is value versus price comparison based analysis. So all the stuff you have done before, all your stock valuation is actually part of this framework, which I'm sure you were not aware of so far, right? You didn't have a clear idea about that, but this is basically what it is. Okay, you are in this box. When you're doing all this stock analysis, dividend growth model, Gordon growth model, and all this stuff, when you're doing this, you are actually in this box. Okay, so you have to basically also understand, if you feel, if your own worldview is that I don't really care about all this stuff, I don't think all this fundamental stuff matters, I think the market is just crazy, it just goes up and down, okay, and therefore I should trade it purely from a technical approach, because all this analysis is a waste of time, because the market is not rational. Okay, if you have that view, I'm not saying you have to have that view, but if you have that view, it's important. That's why I said it's very important to understand what you really feel about the market. What are your views? What are your own approaches? If you have that view, then it doesn't make sense for you to do all this stuff, because it's not consistent with your worldview. Okay, let's say I don't believe in democracy, I believe in violence, and I believe in gaining territory through violence. Then why should I participate in all this voting and all that stuff? That's not a good example, but my point is that it depends on your worldview. So you have to be clear about what your worldview is, and that is what has to be shaped by your projects. The reason I make you do all these live projects is you should develop your own feeling about what the market really is. Is the market really a kind of animal which is susceptible to this kind of analysis, which is better analyzed in this approach? Or is it a kind of animal which is better analyzed in this approach? That you decide for yourself. I'm not forcing you to decide either way, but I'm just saying that this is what you need to do. Okay, you need to go through the exercise for yourself. Okay, so now please understand, okay, what is happening here? Who is talking? Pulkit, you'll lose marks. There should be no talking in the class. Okay. All right. Now, undervalued, we are discussing basically this part, which is, so everything doesn't have to be written down because you, okay. So now you understand what is value versus price. Why am I calling these fundamental approaches value versus price, and what is value agnostic? Why am I making this distinction? Now you understand?
Yes, sir.
So all this analysis that you're doing, this is basically falling under this paradigm. Okay, these are, you heard the word paradigm? Have you or not? New word? Paradigm? You've heard it. Okay, great. So I don't have to write it down. Okay. So paradigm is just a worldview. Like capitalism is a paradigm, socialism is a paradigm. In socialism you have no private property. Okay. So in capitalism you have private property. The different ways of looking at things, that's a paradigm. Okay. So essentially you're in this paradigm. When you're doing all this, you're in this paradigm. What is the objective of doing this fair value calculation? The process doesn't stop there. Why are you even doing this fair value calculation? Like in many of the courses and textbooks, you'll find there's a discussion of valuation. The valuation kind of drops from the sky. Like, why valuation? Why are you doing valuation? Valuation is connected to this decision problem of buy or sell. That you have to understand. That the whole question of valuation comes because of this decision problem has to be solved, because the decision problem has to be solved, and you have decided to solve it by being in this column and not in this column. That is your decision. That is why you need the fair value estimate. Okay, the first step, you come out with a fair value estimate. Second step, you compare the fair value to the price. Fair value is 2,500, price is far below. So being a value investor, now you buy. Because, and why do you buy? If you buy, that means what do you expect about the price? It's going to go up or down? Up. Okay. So the fair value is 2,500 and the market is far below fair value. You are buying, so obviously you expect this to go up, right? So is value investing a mean reversion approach or a momentum approach?
Momentum. Sir, I'm buying because I expect it to go up.
Not grow up, but go up. Okay. No. In a way you're right, because everything really is momentum. Okay, everything really is momentum. Okay, so we have to be very careful about the distinction. But the distinction applies only at any point of time applies only to a fixed time frame, a fixed zoom. In this zoom, you are a mean reversion player if you are buying now. in this zoom. Obviously, you're right in the sense if we narrow the zoom, if we zoom in further and we look at this, you're expecting this to go up. Yes, if we narrow, are you following what I'm saying? If you zoom in further and look at only this degree of movement, you are expecting this to continue at this little rally that has started go up. But the point is that momentum versus mean reversion has to be understood at a fixed zoom only. At this zoom level, if you are buying, actually you are a mean reversion player, because you are expecting now the mean is probably a little bit higher than this. The average level, average price probably is somewhere here, okay, on this chart, and you're expecting it to go and revert towards the mean. That's why you're buying. Okay, so value investing, is everyone clear about this? Did I explain this to you earlier? That value investing is a mean reversion approach? Okay, so yeah.
But sir, it actually depends upon what value we get from our valuation approach. Because if we get a lower value, then we see momentum later.
Yeah. If you have a lower value, obviously, yeah. If you have a lower value, this will happen. Okay. If you have a lower value, then essentially, but that's not how typically. What will happen is, if your estimate of the fair value is lower than this, as a value investor, you will not sell. You will not sell. Effectively, if you feel that the fair value is much lower, then actually what happens is, typically, I agree, logically you should sell. Okay. But typically, then again, when you're selling in that kind of situation, they sell into very overvalued, very strong trends. They typically sell into very strong trends. They don't sell into this kind of a situation. Okay. Typically, when you're a value investor, you would sell. You would think that something like maybe Apple is overvalued. Now people are saying that Apple is overvalued. Some people are saying it. So then you would sell Apple. But Apple, if you look at the Apple chart, it's been pretty much going up all the time. Okay, for the last several years, if you look at Apple. Okay, so it would not work like that. Value investors, when they are selling into a stock, if you want to look at Apple, now I'll just complete the discussion, but that's how it will work essentially. Okay, so value investor will not be selling into this kind of situation, even if they feel the fair value is lower. Okay, so in that case, they would actually wait to buy it at a lower level, let it fall through the fair value or go to fair value. Okay, and then only they would fall through the fair value, then only they would buy. Okay, so this is why we say that, I'll just wrap up this discussion here. So this is why we say value versus price. Now you understand why I'm saying value versus price. So that all this exercise that you do, the objective is to compare it to the fair value, and then if the price is far below the fair value, you would buy it. If it is far above the fair value, you would sell it. Okay, in this case, we'll just have a brief look at Apple. The net is a bit slow, but if you see here, then obviously if you look at the daily chart and all that, you can see this. Tarun, now you see what I'm saying. Now the guy who is going to sell Apple, okay, first of all, value investors typically operate asymmetrically. They don't sell when something is typically value investors only buy when the price is far below fair value. Okay, they don't sell because in the kind of markets in which they operate, that typical selling is not really common. Okay, but if you were a symmetrical value investor and you were selling a stock which is overvalued, your typical estimate would be that the fair value of Apple is something like 100 or something like that. Now it's been going up, it's gone up all the way here. So now again you see you become a mean reversion player, because when it's gone up so much, you're trying to sell, the mean is a little bit lower here, and you're again looking for a movement back to the mean. Are you following this? This is clear now? Okay, so you've learned at least this basic stuff. We will continue this discussion. I think Garvit is getting restless now, so 11:01, okay. Alright, so we can, any technical questions, then I won't close the video right now. Yeah.
One question is, what is the time of expiry of option, like maximum time of expiry?
There's no maximum time. You have to see where the, like here for instance, we are looking at crude oil options. You can see they are trading, if you look at the crude oil options, you can see that they are trading all the way here. This depends, the answer to your question is, the general answer is that it depends on the liquidity of the particular option market concerned. So,
India, the time period is
India, don't worry about India. India markets are not developed. That's why I don't teach you from an India perspective. Because if you learn from an India perspective, you half the things you won't learn.
You were speaking cheaper options. As long as
Yeah, you can buy very long dated options. Depends on what the market is providing. Depends on the market. If the market itself is not liquid, if the underlying, typically you need good underlying liquidity. Okay, here crude oil futures are very liquid. So that's why you see, look at crude oil futures. See where you can go with crude oil futures. You can go up to 2029. Okay, so they have listed options till 2029. I don't know how much will be available, but you can still see something is going on. Okay, maybe we'll see some bid on ask prices. It's a little bit far away. Okay, but maybe there's no activity here. But the point is that it is providing for that kind of listing because the underlying is very liquid here, and the futures market, and so therefore the option market has a chance to be more liquid.
India, the country is of 300.
Forget about India. We are learning theory right now. So we want to learn general, because whatever you learn about option trading, you're going to do a project on US equity options. Okay. Everything you learn in the theory of option trading with respect to US equity options, exactly the same thing will be applied in India. Nothing will change. Except obviously your underlying markets will change, your options will change, and then you'll be constrained by the liquidity of the particular market. So if you're operating in the Indian market, the liquidity is much less. As you saw in the case of your trading of cash stocks on the NSE, half the stuff you can't sell because the short selling facility, the short selling liquidity has not developed, right? So that's why we study with respect to US markets, because the US markets are most developed. So you get to see what a real developed market is like. Yeah. Okay. Any other technical question? Okay. You have a non-technical question?
Yes, sir. Sir, the video which you sent for the project was not working. It was private.
No, you have 1 minute. You have to log in with your DSP ID.
Okay, sir. And secondly, sir, I want to change my group basically.
Why do you have to change your group?
Sir, because people in my
Okay,
group
1 minute.
really do not have a view.